Welcome to the video. I have in this chart 6 times that the yield curve inverted and how many days after it inverted that we reached the bottom of the market. Now the bar all the way to the right is showing how long it's been since the yield curve last inverted currently, and the crash hasn't been reached, not taking into account March, because the March sell-off, that was 306 days after the yield curve inverted. So I feel like the bond market wasn't pricing in that crash, and the crash is to come. But the one that happened in 2009, that was 1,200 days after the yield curve inverted, and we're still on the way towards that. But we've been at least getting to 500 days. In this chart, it's showing the market cap divided by the GDP for the S&P 500, and we're at all-time highs compared to recent decades. So that's indicating a very expensive market. I also wanted to point out that we reached a resistance point for the highs for the dot-com bubble and for the housing crisis. And we also reached a resistance point for the lows in the housing crash and the dot-com bubble. But you can see we've well surpassed the highs. So I hope you found this helpful to be able to see how the yield curve has predicted recessions, and also, from what I've seen, crashes of the market that seem to be associated with those recessions. I suspect that a crash could be on the way, and I'm estimating that we could reach that point by April 2022 if the market behaves how it did in the housing crash. Thank you.